Okay, welcome to this explainer. I am absolutely thrilled you're here today because we're going to dive right into a massive frustration that, let's be honest, almost everyone faces at some point. You're working hard, you're doing all the right things, but when you check that bank account, man, it just feels like your wealth is moving at an absolute crawl. It's a super common feeling, but today we're going to unpack the data, the math, and the deep psychology behind exactly why building wealth starts off so deceptively slow and how you can finally break through that agonizing flat line.
So I want to kick things off right away with this incredibly provocative question from Forbes. Are you building a life that only works if your job keeps working? I mean, really think about that for a second. If literally everything you are building relies solely on that linear paycheck showing up every 2 weeks, you are incredibly exposed. The truth is, most people out there don't actually feel rich, they just feel financially fragile. It's like everything works perfectly, right up until something changes. And as we all know, things always change.
Well, a huge reason for all that fragility boils down to one thing: lifestyle creep. This is actually driven by something called Parkinson's law of finance, which basically states that our spending will naturally rise to meet our income. It creates this crazy income illusion. You know how it goes? You get a raise, and immediately you upgrade to a better zip code, or buy a nicer car, or suddenly you're taking way more expensive vacations. You end up financing your comfort instead of buying your freedom. You're expanding your liabilities, but your actual underlying wealth, it just stays flat.
To break out of this cycle, we need a massive paradigm shift. Over on one side, we've got linear income. A standard paycheck is linear, right? You earn it by physically showing up. But on the other side, we have exponential wealth. True wealth grows when you don't show up. It's quietly compounding in the background while you sleep. And honestly, the gap between these two concepts is exactly why so many high earners can pull in massive salaries, yet still feel like they're just running on a treadmill, never really getting ahead.
So, Section 1, the counterintuitive math. Let's look at why the human brain struggles so much with this.
I absolutely love this quote from the book, The Psychology of Money. It is not the amount of snow that causes ice sheets, but the fact that snow, however little, lasts. When we look back at actual ice ages, the big takeaway is that you don't need tremendous force to create tremendous results. You literally just need uninterrupted, lasting growth. If a tiny bit of growth sticks around to serve as the fuel for future growth, well, even a super small starting base is going to lead to extraordinary results. And the mathematical reality brilliantly illustrates why our brains just can't handle this. Linear thinking is highly intuitive for us. If I ask you right now to calculate 8 plus 8 9 times, your brain easily lands on 72. No problem. But if I ask you to multiply 8 times 8 9 times, your head kind of explodes, right? It's over 134 million. Exponential math is just not intuitive to us. Because the early stages of compounding look almost invisible, we totally underestimate what's possible. And worse, we get impatient.
And because we get so impatient, we fall straight into psychological traps. Financial author Ramit Sethi calls these invisible scripts. Basically, these are the subtle, everyday habits that are quietly draining your potential during that deceptively slow phase of compounding. We inflate our lifestyles. We buy status symbols to impress people through social comparison. We choose instant gratification over future growth. Or, we suffer from analysis paralysis, constantly waiting for the quote-unquote perfect time to start investing. These invisible scripts are the exact reason people quit right before the math explodes vertically.
All right, moving to Section 2, the ultimate cheat code. Let's look at what happens if you don't quit.
To reveal the true secret of massive wealth, we're going to run a really fascinating thought experiment comparing two legendary investors. Take Jim Simons, the head of the Renaissance Technologies hedge fund. The guy has compounded money at an unprecedented 66% annually. That is insane. It's resulted in a net worth of $21 billion. But now, contrast him with Warren Buffett. Buffett's returns are a fraction of Simon's, just 22%, but his net worth? A staggering $84.5 billion. So what on earth is causing that massive difference? Well, Simons didn't really find his investment stride until he was around 50. Buffett? He started when he was 10.
Let's actually play this out even further. What if Warren Buffett was just a normal guy? Imagine if he spent his 20s exploring the world, finally started investing with $25,000 at age 30, generated those exact same 22% returns, and then decided to retire at age 60 to play golf. His net worth today wouldn't be billions. It would be just $11.9 million.
Now contrast that $11.9 million with his actual net worth.
99.9% of Warren Buffett's financial success is tied entirely to the financial base he built in his youth and the sheer longevity he maintained well into his 80s and 90s. So the crucial takeaway here is this. Sure, his skill is investing, but his actual secret? It's time. Compounding is the ultimate cheat code, and it rewards uninterrupted time far, far more than it rewards raw intensity or lucky market timing.
Which brings us to Section 3. Accelerating with leverage. How do we speed this up?
If you want to speed up that agonizingly slow early phase without having to rely entirely on extreme eating beans from a can frugality or waiting endless decades, you absolutely need to utilize leverage. Entrepreneur Naval Ravikant defines it perfectly. Leverage is the multiplier between the effort you invest and the results you achieve. Remember Archimedes from physics class? A physical lever amplifies your output for the exact same input. Well, in modern business, leverage is the ultimate tool the wealthy use to completely disconnect their output from their personal time and labor.
Naval identifies 4 specific types of leverage, and I want you to look closely at how they scale. First up is labor, having people work for you. This scales linearly, and honestly, it's the weakest form. Then there's capital, which scales better. It's logarithmic, meaning it grows fast initially but eventually plateaus, and it usually requires a massive track record to get your hands on. But then we have code and media. Think about software that replicates at zero marginal cost, or a podcast or an explainer like this reaching millions of people for free. These scale exponentially.
Now, the absolutely crucial separation between these forms of leverage comes down to one word: permission. Labor and capital are permissioned. Someone literally has to agree to work for you, or some bank has to agree to give you money. There are gatekeepers everywhere. But code and media, those are permissionless. Anyone, anywhere can write software, start a newsletter, or record content immediately. No gatekeepers required. You can scale your specific knowledge infinitely, for free while you're asleep. Make no mistake, this is the leverage of the newly wealthy.
But here's the catch. Accelerating your wealth through leverage or compounding? That only works if you can actually hold on to the wealth you generate. As Morgan Housel points out in The Psychology of Money, getting wealthy and staying wealthy are 2 totally different games.
Think about it. Getting money requires taking big risks, being deeply optimistic, and really putting yourself out there. But staying wealthy? That requires the exact opposite. It requires humility. It requires frugality. Honestly, it requires a healthy dose of fear that everything you've made could just vanish. Good investing isn't really about making brilliant decisions every single day. It's mostly about consistently not screwing up. It's about sheer survival when the markets inevitably get chaotic.
And this leads us to what is probably a massive reframing of what it actually means to be rich. Ready? Wealth is what you don't see. Society tends to judge wealth by outward appearances, right? The expensive car, the luxury watch, the crazy Instagram vacation. But spoiler alert, that's not wealth. That's literally just money being spent. True wealth is the nice car that you didn't purchase. It's the first-class upgrade you declined. Wealth actually consists of all the unspent financial assets quietly compounding in the background, out of sight.
To really embrace this, it requires a massive mindset shift. Saving money isn't just about plugging some numbers into a spreadsheet every month. Savings is literally the gap between your ego and your income. Because past a certain level of basic human needs, spending is mostly just a reflection of ego. It's a way to signal to other people that you have money. Actively lowering your ego, ignoring social comparison, and truly not caring what your neighbor thinks of your modest car, that is the daily battle required to build actual, lasting wealth.
And, as the legendary Charlie Munger once said, the first rule of compounding is to never interrupt it unnecessarily. Building wealth feels impossibly slow at first because its true power lies entirely in endurance. Survival gives you longevity, and longevity is exactly what allows that explosive exponential math to work its mind-blowing magic over the decades.
So as we wrap up this explainer, I want to leave you with one final, provocative question to chew on. What invisible scripts are currently interrupting your compounding? Are you caught up in the trap of social comparison? Are you automatically spending every single raise you get? Or maybe you're just paralyzed, waiting for the perfect moment to start? Identify those traps today, lower your ego, and finally embrace the slow, permissionless path to exponential wealth. Thanks so much for learning with me today, and I'll catch you on the next one.